Welcome to the next video in the series, and today we're going to be touching on Brexit and the EU and Ireland, but in particular what I want to do is I want to highlight the desperate situation that Ireland is in that nobody seems to have picked up on, which is quite concerning to me because it is potentially quite a large canary in the coal mine, and after this video you'll see why. Now, we can see that there's a lot of uncertainty in Brexit. Today, Prime Minister May just survived a vote of no confidence in the British Parliament, and that's all well and good, but nothing has really changed. The uncertainty still exists there, and therefore if uncertainty exists within the British political system, then uncertainty exists in Europe and the EU, other EU member states, and this ultimately has direct consequences for investors and investments in the European Union and in Britain and in particular Ireland as well. Now, what we need to do first of all to set the stage in looking at why Ireland is in a mess is, rather than look at its GDP figures, what I've done is I've equated to the economies of Europe and even the United States for comparative purposes to GNI, which is gross national income. Now, gross national income is a measurement of the income as opposed to the production of a country, and it's normally doesn't differ much from the GDP, but in Ireland's case there's a huge difference. And let me describe why. In 2016, 2017, the GDP for Ireland was a nominal 334 billion. Now, this had to be adjusted as what the Irish government determined it was going to be a modified GNI to reflect a more realistic figure for what people term GDP. And the GNI figure came in at 190 billion. Now, that is a 44% reduction in the income, the national income, what normal people would think is the national income of the economy. So what does this actually mean? Well, let me go into some detail. The tax receipts for the Irish economy, and tax receipts are ultimately what the government raises from its people to fund things like roads, investments in infrastructure, and payment of debt. Now, the Irish government raised $43.4 billion for spending, and these figures are available from the OECD and from the Eurostats and from the stats, so these are all taken from the relevant government bodies. Now, the World Bank stats showed that Ireland pays 10.8% of its GNI towards servicing its debt. Well, you just do the math. That's pretty well close to 20.5 billion. Wait a minute, didn't I say that they just raised 43 billion in tax revenue? Yes, I did. And what this means is that the Irish government spends close to 50% of its income in servicing its debt. That is huge. And it's amazing to me why other people haven't actually seen this figure. Now, to put this in context, let's look at some other figures of EU nations and other figures in particular. Now, the United Kingdom just pays over a quarter, 26.6% of its tax receipts to servicing its debt. Spain, 16.33%, Italy 21%, the USA 25%, Germany 4.6%, Greece 26.9%. So, I mean, there's very little difference between the Greek service of debt costs and the UK service of debt costs. But if Greece was causing such a massive EU problem, and Ireland's at close to 49%, I mean, wow, I mean, if Greece was a problem, Ireland should be a problem, and I think this has been overlooked. So you've got to look at, well, how is Ireland going to continue paying this? Well, it's got to pay it by continuing to add on more debt onto its economy, and it's in a very serious debt situation, which I'll be going into in later videos as well. But let's look at another measurement of the financial health of a country, and it's rather in comparison to a balance sheet, in terms of what is the actual net position on a company or in a household or in a business, and it's the net position, it's the assets minus liabilities. And when you work this out for a country, it's called the net investment, the net international investment position. And let's look at some figures. The UK has a positive net investment position of 575 billion as of the euro accounts. And that in itself is quite a story, which I'll go into a little bit here, because in 2016 it had a net negative international investment position, somewhere in the region of 250 billion. So they've had an 800 billion turnaround, and I'll go into details in another video on why I think that's the case. I mean, that's one massive turnaround from 250 billion to 575 billion plus. Now, going on, we see that Spain has just over $1 trillion, $1.08 billion of a net international investment position. So it's not in a good position either. Italy, with all the furore been about Italy's terrible position and all this side of stuff, has a net international investment position of 190 billion. So that's substantially less than the UK, and it's substantially less than Spain. So again, it's interesting why Spain isn't more of a worry than Italy. Now, the USA stands at 8.2 trillion. The reasons obviously for that, because one of the reasons is the reserve currency, but it also runs very high deficits, in which we're going to go into in the next video series how that really does matter. The next video, how that really does matter going forward in terms of the global economy. Now, Germany has 1.7 trillion net international investment position, and it's a plus. It's huge. And this was what I went in a previous video when I was talking about Italy, that if Italy as a banking system needed to be bailed out, Germany would have to draw on its net reserves. And I don't think the Germans are going to want to put themselves into the position of other countries that are very financially unhealthy. Now, Greece, massive problems in Greece, with a population of close to 11 million. We've seen, the bank bailouts, the bank bail-ins, the 60 euros a day limits on cash, and it's 278 billion. Okay, and now we come to Ireland. Ireland has nearly 440 billion in the red as far as net international investment position is concerned. Let's just think of that. It has a population of 4.8 million people. And Spain has a population of 48 million people. And yet, for 1/10 the population, Ireland has half their debt. It's absolutely an incredibly untenable position that Ireland is actually in financially. It's amazing that financial analysts haven't picked this up. It's just incredible to me. And it's a smoking gun that's going to go off, leading back to what's going to happen with the Brexit. And especially if there's no deal, all these bare bones, these skeletons in the cupboard are just going to come out, because Ireland is in a horrific position financially. Now, let's even further knock this down into net international investment position per capita and work out what this actually means for each country that we've just covered. Now, the UK has $10,000 per person positive in net international investment position. Spain is in a deficit of minus 26,000. Italy, small, minus 3,600. So their assets and liabilities in terms of their population is not necessarily that bad. But it's not good because it's negative. But it's not the most terrible situation in the world. So maybe some figures are good in Italy, as well as obviously some figures are bad. Their banks in particular are in a very bad position. But again, we'll cover that later on. The USA is down $25,000 per person, so it's pretty highly indebted. And Germany is up $20,000, nearly $21,000 per person. Greece is down $30,000 per person. And Ireland is down $105,000 per person. Now, that's for 4.8 million people. Well, over half the population doesn't pay tax. So you can see that in most of these cases, you could almost double the figures. You increase them by 40%. But if you did that in Ireland, it's the granddaddy of all the debt in the world, basically. And it's just something that's on a knife edge that is just beyond comprehension why other analysts haven't picked this up. So let's go on to what this further means. Now, Ireland has been, and understandably so, very concerned about the hard border, soft border, because of the history of the Troubles in Northern Ireland. But one thing that the media isn't telling you is that Brexit is terrifying the Irish in particular, because if there is a new trade deal that has to be negotiated, this is going to cause a delay potentially in exports. There's problems with Northern Ireland in terms of the border. This is a nightmare situation for Irish politicians, but in particular it's a nightmare situation for the Irish economy, because a very high percentage of Irish exports go through to England. And so it's a very, very important market for the Irish economy. Now, furthermore, if we go into the banking system in Ireland, now Ireland is in a very bad situation, and certainly in the 2011 and 2012 monetary crisis, Ireland was one of the recipient countries of a bailout, to be honest, about $80 billion worth. But the trouble with Ireland is that it's squandered that. There's been a housing boom in Dublin, which is cooling off at the moment. One of the main industries in Ireland is the tech industry, and that's with Google and Apple and Starbucks, and it's an offshore tax haven. So if there's any fallout from these industries and the high-paid salaries go, then there's going to be a much higher potential probability of bank defaults, and we could sort of see a property bubble bursting again in Dublin, just like there is one in Australia that's bursting, etc. And that's not good again for the situation. There's a lot of dominoes that are potentially going to fall in Ireland. Now, the Irish created a specialist vehicle which many countries have looked at as a potential for pretty well putting bad investments into bad banks. And they created what's called a body called NAMA. And NAMA is the National Assets Management Fund, where basically all the bad debts of the banks, basically the 80 billion that was provided to bail out very bad banking, was put into this fund. And there was close to 400,000 excess houses that were built in Ireland at the time of the boom, and it's a population of 4.8 million, so there was 1 in 10 new houses that lie empty at the moment. They haven't been sold, they're still empty, and they haven't been really put on the balance sheets of the banks. So what does this mean going forward? Well, this means going forward that I believe that there's going to be a serious bailout needed by Ireland. I mean, there's a serious bailout needed in Italy, and that's just, the EU's just kicked that can down the road because of the problems with Brexit. So nothing's been cleaned up. We still are in a position, Ireland is still in a position, it's very, very financially fragile, although they won't admit it because it would be Armageddon as far as the Irish economy is concerned. So they're going to need at least another 80 billion, but hold on a second, I mean, they might need more than that because Italy's going to be going for close to 500 billion. Spain, as I've said, is going over 1 trillion in negative net international investment position. We haven't even touched on Portugal and Greece yet. So again, Germany, not going to fund it. Do you think the Federal Reserve is going to fund it? Maybe, maybe not, but it's a massive, massive problem. So Ireland is in real trouble. And, this is going back to that 575 million, changing the subject slightly, this 575 million that the British have put aside in positive net international investment position. I think that the British have been much wiser than most people will actually credit them for, because they've got a cushion just in case the proverbial hits the fan. And Ireland has nothing. I mean, Ireland's got Ireland's ironically one of the largest international investors in US Treasuries, close to 390 billion last reckoning. But this is counted in their foreign debt. This is counted in their liabilities. They've only got about 250 million in gold reserves. So Ireland doesn't have much liquid cash to bail itself out of any position. So going forward, Ireland is in an extremely bad position financially. It's only a matter of time, in my view, before the cat comes home to the chicken pen and basically devastates the economy. And the worst thing is there's nowhere for the millennial population, the young population of Ireland to go, because the BRICS economies are in a very bad state. There's 33% youth unemployment in Spain, similar in Italy. They can't all be taken by Germany. It's just not going to be feasible. So hard times are coming. It's only a matter of time before they recognise this before the whole situation implodes. Now, what does this mean from an investment point of view? Well, again, it goes back to debt. You see, the Irish economy is going to need a bailout, a substantial bailout. The Greece economy is going to need another bailout. The Portuguese economy is going to need another bailout. And it looks like France is going to need help. So it looks like the European Union is going to be under tremendous pressure to keep the countries within it and their economies liquid. And this goes back to the idea that I had before in a previous video, that to me the euro is in a stage of potential cataclysmic annihilation as a reserve currency, because ultimately, when the penny drops that Germany can't and won't fund these unbelievable demands on the banker of the ECB, it's curtains. It's curtains for the whole EU experiment. And this is ironic, because I did say it again in the previous video, that the European Union just might collapse before even England manages to break away, whatever type of breakaway that is, from the EU, whether it's a hard exit or a soft exit. Bottom line is that it's rather like the barbarians at the gate. The European Union has too many problems that are coinciding at the same time to survive in its present form. And it'll be very interesting to see, and it's very dangerous for, as I said, for investors either within Europe or investors that have portfolios that have got some exposure to either the European banking system, European stocks, or sovereign bonds, or debt in particular. So this is a very important sphere to watch out for, and it's really, really important to look at the political process, because it does affect the whole investment horizon, certainly now and certainly going forward into the future, because there's a lot of volatility which can be traded, but there's a lot of uncertainty as to what the future of certain safe investment classes have. So the next video that I will be looking at three areas. We'll be looking at the EU, United States and China in unity, in a unison of what's happening in the global economy. So thank you again for watching this video. Please give a thumbs up and subscribe to the channel, and I look forward to talking with you in the next video. Thank you and bye.